Welcome back. I'm here today with Monty Kersten. Monty is an independent board member of Young Startups and Angel Investing. Monty, welcome to today's show.
Delighted to be here, Alan.
So, Monty, how did you get to where you are in your position today in life?
Well, I was raised in Iowa as a very conservative Midwestern family with a father who didn't believe in borrowing money and believed hard work made everything. Came out here to Silicon Valley with dreams about having some great achievement come true, and by hard work and a lot of luck, I was able to found a successful software company and then become independent and able to help ventures and founders with the support of me on their boards as their independent board member, apart from the venture capitalists who share those board positions. And I also invest as an angel in select young startups.
Yeah, you have a legal background also.
Yes, we try and keep that a secret, and I haven't practiced for 20 years. However, you practice every day, and you never lose that part of your brain. It's very helpful to have a legal background in this contentious world as you build value for shareholders.
Well, I imagine that does prove, as a board member, very valuable to the perspective of helping companies as they scale and have growth and go through their legal contract negotiations.
Especially if you can use the law as a tool for the business goals. Many times the law becomes its own purpose, and it's much better to turn it to the benefit of the business goals of the young company.
So, Monty, I want to jump over to the angel investing industry. So, what changes have you seen in this industry since you first started?
Wow. Well, of course, I've been in the Valley for 35 years. Angels in those days were thought to be an angel that came along and saved the business or sponsored it before the venture capital firms came in. And angels were individuals like Arthur Rock, a very famous name here in Silicon Valley, people that backed Apple before it was public. And then it transformed from individuals into almost baby venture capital firms that did angel stage investing, that is at the beginning before the venture capitalists came on the scene. So it has changed a lot into more individuals are morphing into firms that are angel stage.
Now you're working with relatively young companies as they're beginning to scale, and I think a lot of these companies have reputations of burning through cash relatively quickly. Is that a good sign, or how do you help companies as they scale growth to balance between their spending and getting up to profitable break-even point?
It's a critical question. I come from the old-fashioned view of capital efficiency, high productivity, building huge shareholder value with small injections of financing. I respect the worlds of the Amazons and the Ubers that have these massive amount of funds raised and are really not profitable but high growth and massive market footprint. I don't know how to do that. I like the old-fashioned way of modest capital, hard work, great productivity, profitability, save, conserve, and build cash after you have to burn it for a short period of time. And I'm reminded of World War I when the British were criticized for not having enough casualties in the Battle of Somme, which showed they weren't trying hard enough. And that's the wrong approach in the startup world. Be capital efficient.
It's a great analogy. Not enough casualties, I guess, is one thing we want to avoid.
Yes, and you can run out of money way faster than you think.
So are we currently in a startup bubble right now?
Everybody has their own view. I strongly feel we are in a startup bubble. We've had a record amount of venture capital dumped into companies that aren't profitable, that aren't having exits. We have almost no IPOs. We have many fewer acquisitions than is said, and a whole lot of unicorns with no way out for investors. I think there's a big bubble going to pop here, and I think Silicon Valley traffic patterns are going to get easier for our commutes in the next year.
This is interesting as we're looking into the industry, and we hear about in November the revaluation for the unicorns coming out, and when we look at companies today, how does all this affect the fact that there are no exits?
It's a very, very serious problem because the venture capitalists promise their investors returns that are liquid cash. They have to return cash or public stock to their limited partners as a way to pay them back and reward them with returns on their capital. And if they have no acquisitions of their own investments and they have no IPOs, they don't have any value yet beyond just the paper stock certificate that they can give back to their limited partners. So there is an imperative to break the logjam in IPOs and to have acquisitions happen more frequently. And it's a puzzle.
I'm visiting here today with Monty Kersten. He is an independent board member of several startups and also an angel investor. Monty, I need to take a quick break, and we'll be right back after these messages. Thanks.
I love fishing, with my family.
I think it would be easier to use a net.
It was so much fun.
The times when we are together, it makes it all the more worth it.
Having Dad teach them how to cast a fly rod, and
as long as we're doing stuff together, we're having fun.
Some people see a father and a son fishing together, while others see a succession plan. Welcome back. I'm visiting here today with Monty Kersten. He's an independent board member of several startups as well as an angel investor. Monty, in the first segment, we're talking about state of the industry today. The past few years, there's been a flood of money coming out into the markets, new startups happening, and what do you think is going to happen?
I think we're going to see a revisiting of the dot-com bust, not so much in dot-coms today, but in young startups that have raised too little and spent too quickly and have too thin a business model and didn't have a plan to win customers and turn profitable in time. I think you're going to see a lot of washouts intentionally let go by the venture capitalists so that they can concentrate on the stronger horses they have running in the race.
When these companies are starting to roll out and you get a flood of startups, the smart ventures will strive to get companies to break even as quick as possible in the most efficient manner, and beyond that. But as a independent board member and looking at over governance, are there certain tools and trends that you try to help companies navigate through?
Yes, of course. I always try and focus the founder and the management team on profitability as soon as it's realistic to achieve, and cash management in the meantime. So you want to always have enough money in the bank when you raise a round for 18 months or 24 months of operations. And you must have the religion of a business plan that projects what products you're going to offer in what time frames, what the sales cycles with customers with those would be, that is, how long is the delay once you start with the customer to win an order, how many orders can you win over time realistically with the resources you're devoting to penetrating the market. And it's a race against time where, of course, you are going to run at a loss in the early days, but you want to reach that break-even point as easily and even as early as you can in a way that is realistically possible in the competitive market they exist in today.
When you're looking at new startups, there's all sorts of different types of ways startups can be structured, from LLCs, C corporations, S corporations. And as a board member, are you concerned about tax efficiency as much as return on investment? Or do the two play into each other?
Great question. I always strongly encourage C Corps, Delaware C Corps. Forget about LLCs, forget about S Corps. If you're stuck with that as your heritage, I usually encourage the founder to reincorporate in Delaware as a classic C Corp, because that is what all investors are most comfortable with. If they're in an S Corp, investors are going to have all kinds of tax effects that they weren't anticipating. They just want to buy a C Corp stock, have long-term capital gains, and great returns.
Why Delaware?
Delaware is the most friendly corporate jurisdiction to put a corporate company in as a startup. You can do a California Corp, but if you want to look really long-term, Class A, high-quality investment to investors, you want to be a Delaware C Corp, no question about it.
So if we go back to looking at the unicorns, we heard news in November last year about revaluations of unicorns. And first of all, let's start. What is a unicorn?
A unicorn is just a slang term that the venture capitalists put on a company that had a theoretical last time around priced at around out the door market cap of $1 billion based on how many shares are outstanding, including stock options, It has nothing to do with the real value of that company. It's a moment in time.
Do you feel that the time of the unicorns is over?
There will always be companies that are worth $1 billion and are private. So I don't think the time of unicorns is over. However, I think there's a whole lot of froth in the unicorns today. And what is not understood is when Fidelity puts $400 million into Uber on its last round, and it's valued at $62 billion, and those are not accurate numbers, but they're a good example. Fidelity is saying, and I get all that money back before anybody gets any money. So what you're seeing is some of these late stage financings that push the valuations up to $1 billion are illusory, because if they pull that huge amount of money out and take it back, the company could lose all of its remaining capital and truly go bankrupt for all the other investors.
Monty, I need to take a quick break. Visiting here today with Montgomery Kersten. He's an independent board member of several startup companies and an angel investor here in Silicon Valley. We'll be right back after these messages. Since you can't take your wealth with you, spend time with your family. Welcome back. I'm visiting here today with Montgomery Kersten. He's an independent board member, several startup companies here in Silicon Valley, as well as an angel investor. And we were talking about in the prior segments about the state of the industry as a whole. When a company is receiving a finite amount of resources in cash, as a board member, how do you direct and steer them to put those resources to best use?
I always ask them to focus on building value, which means building products offerings or services offerings, getting to the market in time, winning referenceable customers, building customer delight, not just customer satisfaction, getting your core customer footprint established, and then extending from there so that you can become a master of your own destiny rather than look about losing money for years and having to get round after round.
So entrepreneurs are driven by their passion and their ideas, but as a seasoned investor, you take a totally different approach in terms of trying to get value into the investments. I want to spend a few minutes walking through the different stages of investing, such as the angel, the Series A. Walk us through at what point in time should a company be looking for different series of investment, and what is a Series A, B, and C round?
These are often misunderstood, and I'm glad to go into it with a little bit of detail. I think the first thing to recognize is if you're going to build a venture that is not going to be bootstrapped, but you're going to need to go out and recruit investors for it, and then you need to think about how much capital over time you're going to need, and you want to think about how big do you want to build the business, and how do you want to reward investors on the long-term stage. You want to start then with progressive funding. You don't raise all the money the venture needs at the beginning. You raise about 18 months to 24 months worth of time in the sense of cash raised to be spent over the next time as you build the product, build the team, win the customers, and turn into having revenue be higher than burn and expense. So if you're going to fund it progressively, the first round to consider is just going to individuals who are angels who are often insensitive to the very tough deals that VC drive at that early stage. And the angel might have a little more romance about the company and being involved with it, and a little bit less of a sharp pencil in pricing the round. That allows also the founder and his team to have some supporters as initial stockholders who are individuals, angels who believe in the people, and then after that angel round of maybe $1 million or so is raised and you build furiously the value with that $1 million, you go back out to the venture capital community or the institutional investor community for the classic Series A priced round of preferred stock issued for maybe $2 to $10 million, depending on what you might want to do with that. And if you're a software company, you can be very efficient with that capital. And then after you've spent a bulk of that, you want to go back out after you've built a whole lot more value in team, customers, product offerings, intellectual property, and consider a B round, which is supposed to be, every time you go back out, you should try and have a 3x uplift. So if the angel value is at $5 million pre-money, you'd like to have the preferred A be at $15 million pre-money valuation.
When you're looking at the value a company takes on, are they essentially committing their company to have to go to a certain value to make the return for their investors?
Absolutely. You must, whether it's truthful or not, you must always have a model where your company is going to return to investors a minimum of 10x as a rule of thumb on the amount they put in order to justify the risk. And angels, when I work on an angel deal, I am often looking at a 20x or 30x or higher return on a $5 million pre-money valuation. I want to see 20 times that on the back end. If it can't grow big enough, then it's really not something I want to risk my funds on, and I'll let somebody else chase it as a mom and pop venture.
When you're really looking at these deals, and I'm sure you get a lot of them that get presented before you, how do you decide which one you get involved with?
That's a very good question, and I can tell you that those decisions are made very differently by angels. I'm 61, I've been doing this a long time. I'm intuitive, I'm not very good at analytics. Excel is not my great strength. I certainly do understand all those metrics. So first, I look at the market. You often hear people is what they invest in. First, there has to be an explosive market trend, unstoppable, a massive wave you can get on and surf for years. Market kills a lot of deals that sound great otherwise, but there's no market. So after you establish that, then you want to look at the team and the leader, the founder or the CEO, and you want to believe that they will do everything it takes and devote all of their energy wisely and listen to others as they forge ahead. They just have to do it kind of a feeling. Then you want to think about the idea, and the idea better have some breakthrough potential, and it has to be good enough to be critical mass size. If it's a baby little imitation of Evites for different kind of invitations for nonprofits, for example, on the internet that gives money back to nonprofits, that's just too baby an investment. There's no critical mass, just as an example. So those are the most important things. Then, of course, they have to have a business plan that makes that capital efficiency I was talking about earlier pay off. Well, for what? Return on investment to shareholders, building huge value for the shareholders willing to take the risk and the team members working so hard to achieve it.
You know, Money, you're 61 years old, as stated earlier, and a lot of these new entrepreneurs, the millennials, they don't think like the old guard. How do you work with the millennials today?
Well, sometimes you can't work with them. I've resigned more than once from a board where I just didn't feel I was being listened to. But the way I work with them is just get them to understand that what they read about on the internet is not always true. All the fairy stories they have about how ventures pop overnight like Instagram, existed a year, 12 employees, Zuckerberg bought them for $1 billion. It really did happen. And it was a brilliant move by Zuckerberg and Facebook. It's proven already in their results. Don't count on that. Instead, think about that old value of hard work, high productivity, capital efficiency, never say die, and make sure everybody works really hard. You cannot do a startup on a 9-to-5 attitude with no weekends. I've never seen one succeed.
They have a viral video on the Instagram about how the owners were saying we were asking for $2 billion, but we ended up settling for $1 billion.
Yes, please don't regard those as normal concurrences for your results.
So, what advice would you have for a startup?
Gather around you people who have done it before, put them on the advisory board. They're not full-time employees. Listen to the experience and wisdom. Many times your early investors will be advisory board members or board members who can help you, who will guide you, and who will be supportive of you when things go wrong. So gather around you wise people who've done it before and do compensate them on the upside of the company. And at the same time, be the founder who drives the company forward with a vision and a concrete, achievable plan. Never let down the bar in hiring. Only hire world-class people who are willing to work as hard as you. And don't ever think you can do it without 6 days a week, 5 in the morning till 7 o'clock at night, or however you want to swing that time zone.
There's a few more areas that I wanted to delve into.
Sure.
Okay, the first area is the essential aspect for investors to look for once they're a year down the road.
So a startup is a race against time. And after a round of investment comes in, those investors are expecting in 1 year you to have created a great deal of value harnessing the resources they provided. And they don't want you to spend them all. They want you to be able to go back out and seek additional funding in the market after you've built that value. So usually they will want to see the concrete in progress on the plan of the company, which includes hiring the killer team members that you need to execute while hurrying to market with the right kind of product offering that's going to appeal to the market, while winning customers, your initial handful of customers who will end up loving you and be able to say that as a reference to others.
What advice would you have for a new entrepreneur seeking investment capital?
A new entrepreneur seeking investment capital. Number one, don't believe everything you read on the internet today. There are many illusions that you cannot afford to believe in. Wishful thinking is the most dangerous thing a startup can engage in. Instead, I would urge you to prepare. Winning funding from investors is much harder than you think it is. You need to look professional. You need to be polished. You need to have carefully reviewed your pitch. You need to understand that you need about a 1.5-page executive summary. You want to get introductions at the partnership level to investors, not associates, if you can bypass that time-wasting area. And then you want to have a crisp 1-hour pitch that is going to cover all the aspects that investors care about. You only have a first impression time to get them to not reject you. Don't forget, venture capitalists often invest only 6 times a year, but they see 3 companies a day. And they never tell you about that math, or you wouldn't even show up for the appointment. So don't believe you can beat those odds without having a killer pitch, passion in the room, and as much critical mass and value already established as possible.
When you're at the initial stages of launching a company, how critical is your board at that point? And at what point do you begin to organize and build out your board?
That is also an excellent question, and you will find differing approaches there. The reason that I am often requested to become an independent board member, because I was a successful CEO, and because I serve as an independent board member, not as a representative of a venture capital firm, is because the founder wants that operations advice that comes independently for the good of the business and the good of the shareholders. The venture capital firms represent first and foremost their investment as board members. Of course, they want to build the value of the company, but they approach it fundamentally differently than the CEO and founder and the independent board members do. They share many common interests. So as you build your board, you will find that the dirty secret of Silicon Valley is 2 out of 3 founders are replaced by their board of directors over the life cycle of the company. And this happens very often when the founders are no longer able to scale the business in the mind of the venture capitalist, and yet the founder feels he's capable of it. So a founder at the beginning is benefited by architecting a long-term plan for the board membership that is not just going to be 1 founder, maybe 1 CTO, and 3 venture capitalists that will outnumber in the boardroom the vote every day. Rather, the founder should be thinking about how can he have a more harmonized and an even-handed board with some experts on it that don't just represent the venture capital investors.
Monty, if somebody wants to contact you to solicit your help to come in and introduce their company, how would they go about that?
I'm on LinkedIn, or you can send me an email at montgomery.kersten@gmail.com.
Monty, it's been a pleasure having you on today's show.
My pleasure too.